Hello and welcome to BloombergQuint. We're in a conversation with Neil Parag, that is the chairman, and Rajeev Thakkar, who is the chief investment officer at PPFAS Mutual Fund, and we're here to discuss their investment strategy and philosophy as we head into the new financial year. First of all, thank you so much for joining us, gentlemen.
Thank you.
Rajeev, my question is for you. The Indian benchmark indices are at record highs. How are you reading the markets now? And what I want to understand is if you are holding out on fresh investments considering the levels that the markets are at.
Sure. So what happens is when earnings grow and over a period of time, markets keep hitting fresh highs. So there's nothing new about it. So the Sensex started at maybe 100, sometime it reached 200, 400,000. So nothing surprising about it reaching 30,000. What matters is the pace at which it goes and whether earnings are following the increase in the indices. Today, when we look at the valuations, we seem to be at the upper end of the range. Valuations are not very cheap. However, there are two sides to the story. The large and mid cap space is not looking that expensive relative to the small and mid cap space, which has had a very, very strong run. So it is the small and mid cap space where more caution is needed today.
All right. Neil, I wanted to understand your growth and expansion plans. You've launched just one scheme in the last 3 years and you're focusing on that. Any plans to scale up?
So as of right now, I think we're going to concentrate on this one scheme. I think we're a single scheme mutual fund. I think that's kind of a USP is that we can do everything within this one scheme. We can invest geographically. We can invest across market caps, across sectors. Going forward, there are a couple of plans. One is obviously an ALSS scheme that we'd like to launch, and maybe a liquid scheme. But this is not in the near plan future. Maybe maybe a year down or something like that. But currently, I just see one scheme, us being one equity scheme right now.
Okay, so with respect to your long-term plan, long-term fund right now, is the idea to keep less stocks and hence a relatively more risky portfolio? And of course, you've partly answered the second part of my question. In the event of expansion in assets under management, will there be an expansion in the number of stocks going forward?
I think for us, the ideal amount of diversification is about 20 to 25 stocks. I think we will stick to that asset allocation.
Okay.
Yeah, so I don't think it's very risky. I think going abroad and having 30% outside the country actually reduces the portfolio risk.
Okay.
So we're not taking 100% country risk on India.
Right.
I think 30% being outside the country actually balances the portfolio out very well and actually reduces the risk.
Okay.
I'll also weigh in over there. So
sure.
Let's look at two extremes. Let us say you put 100% of your fund in a single stock. 100% weightage to one stock. Now, if that stock falls by half, your NAV falls by half, right? At the other end, let us say you are invested in 100 stocks.
Right.
Now, if your best idea has just 1% allocation and you are spreading across 100 stocks, even if your best idea, let's say, triples, on a portfolio basis, the return will be only 2%.
Sure.
So you don't want to be in a single stock as well as you don't want to have 100 stocks, especially in an actively managed portfolio.
Absolutely, yes.
In a, let's say, a index tracking fund with 500 stocks, that is fine. But where you are actively managing, you want meaningful allocations to your best ideas. And when you are looking at a 20 to 25 stock kind of thing, it's about 4 to 5% allocation on an average to each individual company. In such a scenario, if there's a fall, it does not impact the portfolio too much, but at the same time, it allows your best ideas to contribute to portfolio performance.
You know, Rajeev, in some of your talks earlier, you've also mentioned that the distinction between value and growth is too simplistic. Keeping your philosophy in mind, in that case, could you explain this concept a little more?
Sure. So, let us say if your target return or cost of capital for equity, let's say, is 15% and the target return is 15%. Now, you can buy a stock at, let's say, 5 PE and no growth and no capex. So all earning is cash flow. And if it's paid out, then you can achieve your target return. On the other hand, you could buy something with, let's say, 10 times earnings or 15 times earnings, but where the earnings are growing in a capital efficient manner, and high return on equity. So you can achieve that target return across various kind of sectors, various kinds of companies. When people talk about value investing, and especially in the Buffett kind of framework, people talk about working out an intrinsic value for the company and trying to buy the company at a discount. It does not mean buying high dividend yield, buying low P, or buying cash rich companies. It may not necessarily mean that.
All right. I just want to come back to the point where we were discussing that 30% of your fund has exposure to global companies. Unfortunately, this also comes at a time when the rupee has been appreciating. So how do you deal with that? Do you have a perspective on where the rupee is headed?
Sure. So we don't take much of a view on rupee dollar rate. Our objective is actually to hedge out most of the currency exposure to the underlying stocks. So anywhere between 85 to 90% of the underlying currency exposure is hedged using currency futures. So whether the rupee appreciates or depreciates, that does not have a material impact on the NAV of the fund. Our focus is more on stock selection rather than trying to predict currency.
All right. So based on that as well, I wanted to ask you that in technology, Alphabet is one of your largest holdings, and this is, I'm talking about technology. This is followed by Persistent, TCS, and Emphasis. Is this again more to do with being stock specific, or is this to a certain extent maintaining balance between an American company and Indian companies?
So I think we look at bottom up stock picking. So it's not that we look at a sector and say, oh, we want X amount of exposure to this company. I think if we like the company, I think we like the prospects of the company going forward, we will buy that company. So maybe tech is a little heavy right now, but it's just basically because we like the underlying companies. It's nothing to do with a sector exposure as such.
Rajeev, banking and financial services is your biggest sectoral bet with an exposure of about 25-26% but I see only private banks in your list of holdings, HDFC Bank, ICICI, Axis. So you see no hope for government-owned banks?
See, a lot of people try to make this distinction that there are good public sector banks and there are some bad public sector banks with trouble. So you can avoid the banks with very high NPA numbers, but go with better run banks. The fear that we see is that ultimately Government of India is the owner of both the banks. In a crisis kind of scenario, in a scenario where one bank is clearly not going to sustain on its own, there could be mergers happening whereby a weak bank is merged with a stronger bank, in which case all the problems come to the larger entity, merged entity. And to an extent, our banking sector has had a history of being more of a social enterprise, trying to achieve financial inclusion or give out loan to the needy and things like that, which is a good part as a citizen, but as business owners, many a times these are not run as profit-making enterprises, or shareholder interest is not primary many a times. So we prefer to stick with public sector banks, private sector banks.
Well, I do have a follow-up question that we have an RBI policy tomorrow. So the current odds are that they're going to hold rates, if I'm not mistaken.
Right, but they need to manage liquidity somehow, because most of the banks do continue to say that the liquidity influx that they saw in the form of deposit, probably most of it stays back, and they haven't seen the kind of withdrawals that we were expecting previously. So your thoughts on what the RBI could do or should do?
So I think RBI is the best judge for that, but I'll give my 2 cents here. See, already the bank rates are at a level where it's not attractive for the depositor. So a lot of money is flowing to either the small saving or the RBI bonds, and in fact the rates on those have not come down as much as was promised according to the formula. So the rate cut has been only 10 basis points over there. So if banks keep cutting deposit rates, they will see outflows, and money could go anywhere. It would go to gold bonds, it could go to small savings, debt mutual funds, equities.
Right.
So I don't see rates coming down in a vacuum, meaning at one level you have pegged rates higher and at the other end you want to keep bringing rates lower. Again, US is in a tightening cycle. So I am not in the easing camp surely. We'll
Okay.
see what happens.
All right.
All right, Neil, but we've also noticed that you do hold a bunch of pharmaceutical stocks, and we know that every now and then there are some issues with the US FDA. When do you think would be a time when we actually see these US FDA issues a thing of the past? If it's been a good 4 or 5 years and these issues have been around, what is it that's lacking? Is it understanding of these pharmaceutical companies that have to do with these US FDA norms? What is it, and when do we see this thing as a past?
So first thing is that we've bought most of the pharmaceutical companies after the US FDA warning.
Right.
So
Yes,
once
we
it comes
noticed
down,
that actually.
yeah. I think it's again, I guess it's about the understanding of the laws
Right.
that needs to be understood, and maybe we will see these problems for a bit more going in the future. But I think as we go ahead, I think the companies will find out, they will realize themselves what they needs to be done,
Right.
and I think they will adhere to those rules.
Right.
And
So one of the reasons for the extended timelines has been what they need to meet is what is called the CGMP, current good manufacturing practices.
Right. Right.
Now the important part over there is current,
Right. Okay.
because the goalpost keeps shifting.
Okay. All right. Okay.
So
Yeah.
if there was an observation 4 years back saying meet ABCD,
Right.
and you go back to them saying I have complied with ABCD,
Right. Right.
but they'll come back and say, but those were the requirements then. Today the requirements are far more stringent.
Right. Right.
So at one end there is a certain element of shifting goalposts, but companies are trying very hard. So actually the way it works in the US is ex-regulators become consultants and then they go on consulting private enterprises.
Right.
So a lot of these consultants have been brought on board and they are advising pharma companies.
Right.
See, time will tell how it pans out, but our take is that ultimately US needs to bring down its pharmaceutical costs,
Right.
healthcare costs in the
Yes.
country, and generics are should be a big part of that. So the opportunity has not gone away. At the same time, Indian companies need to be sensitive to the challenges of quality, and they have to be continuously upping their game rather than be reactive.
Okay. Okay. And well, my final question to both of you is actually, of course, there are a lot of ideas which are not part of your portfolios right now, but what are the ideas that you're keeping an eye on right now which may require some tweaks in the environment, or maybe some tweaks in that particular sector, or that for that matter, that company? And I understand you won't be company specific here. Are there ideas out there, and if there are, what are they that you might be watching out for before you can see some changes and you may want to venture into them?
So a large part of these would be ideas where we like the company but we don't like the valuation.
Okay. All right.
It's not that there's something completely undiscovered out there, meaning
Right.
we would be the first ones to find a completely new continent,
Right, right,
as
yeah.
it were.
Yeah.
These are existing companies, existing businesses.
Right.
It's just that you have to wait for the opportunity to seem right.
Okay.
So most of the time we spend in terms of trying to understand nuances of business and cover a wider set of sectors.
Right.
And sure, once in a while new listings keep bringing new sectors. So for example, diagnostics was a space where earlier we did
Right.
not have listing, and
Yes.
now there are. Insurance, earlier you did not have insurance companies, and increasingly you will have opportunities in the insurance space. So we look at new entrants,
Right.
but typically we are not the first ones to jump in. Airlines, for example, again, Indigo listing was a new one, although in the low cost space, although you had Jet and Kingfisher and all listed in the past. But typically we are not the early entrants in new listings and new sectors coming in.
Okay.
Mainly it's about us waiting for a company we like to come to us at the right price.
Right.
I think we have quite a few other companies on our watch list, and we keep monitoring those companies. They might not find a part in the portfolio, but going forward, like he said, as and when the valuation comes down, we'll probably take a more definite look at those companies.
Yes, of course. And I was going through your website. You had mentioned that volatility is a good friend.
Yeah.
And that makes for an excellent point. But with that, I'm going to conclude our conversation, and I want to thank you guys. It was a pleasure speaking with you, Neil, Rajeev.
Thank you.